Have you ever felt a tiny tremor under your feet? Not an earthquake, just a subtle warning that the ground is shifting. That's the feeling I get when I look at the global economy today. People talk about market corrections, about downturns. But history tells us something darker. Sometimes a system doesn't correct, it breaks. And 2026 could be one of those stress tests. Not a guaranteed crash. A credible scenario built on signals that have flashed before every major collapse. Stay with me. In the next couple minutes, I'll show you why this isn't fear-mongering. It's a warning drawn from clear red lights most people are choosing to ignore. To understand what makes 2026 different, we have to begin where modern panic learned its shape. 1929, the Roaring Twenties were a world drunk on optimism. New technologies, radio automobiles, were changing everything. Stocks soared, and ordinary people borrowed money like never before just to get in. It felt like the party had no ending, but the red light was already there. Leverage. The boom was built on debt and speculation. When the bubble finally broke in October 1929, the fall came faster than belief could adjust. Banks failed. Fortunes vanished overnight. And the world slid into the Great Depression. Here's the takeaway from 1929. When a system is built on excessive debt and overconfidence, the collapse is always harder and faster than anyone predicts. Now fast forward to today. Look around. We live in another era of breathtaking innovation. AI, electric vehicles, space exploration. Markets, even after shocks, still sit near historic highs. And debt? Debt today isn't a mountain, it's the atmosphere. So what's different now, and why could the fallout be larger? Let's go signal by signal. Signal number 1, the scale and the wiring of global debt. Here's the red light. Debt is no longer local, it's networked. In 1929, most debt was trapped inside national borders. Today, we live inside an interconnected financial web. Government debt, corporate debt, household debt, mortgages, credit cards, student loans. All of it ballooned to levels the 1920s never imagined. We're not talking about one country wobbling anymore. We're talking about a global house of cards where a failure in one major economy can ripple outward in hours, not months. This is the first reason a 2026-style crisis could spread like wildfire. Same pattern, bigger system. Signal number 2, the everything bubble. Here's the red light. When bubbles stop being selective, risk becomes systemic. In 1929, the core bubble lived mostly in stocks. Today, it feels like almost everything has been inflated. Stocks, real estate, cryptocurrencies, even speculative collectibles, things people treat like assets now. Why? Because for more than a decade, interest rates hovered near zero, and central banks pumped enormous liquidity into the system. Easy money doesn't just lift one market, it lifts all markets at once, so when the correction hits, it won't be a single collapse. It can become a synchronized implosion across multiple asset classes. Imagine this scenario. Your stock portfolio drops, your home equity drops, your crypto drops, all at the same time. That wasn't structurally possible in 1929, and it is now. Same pattern, wider blast radius. Signal number 3, the speed of information and panic. Here's the red light. Panic now travels at the speed of code. In 1929, fear moved through newspapers and telegraphs. Runs on banks were physical and local. Today, finance is digital and instant. A single tweet. A single algorithmic spiral. A single liquidity shock. And billions can vanish in seconds before most people even understand what they're seeing. The bank runs of the future won't be lines outside a branch. There'll be millions of people trying to pull money out digitally, all at once, potentially freezing the system in real time. And the psychological impact is different too. Watching your life savings evaporate live on your phone is a kind of panic the 1929 generation never faced. Same pattern, faster fuse. So why does it feel like nobody is ready? Because we've fallen into a trap history knows well, normalcy bias. We've had crises, .com bust, 2008, and each time rescue came. Central banks stepped in. Rates fell, money was printed, markets were propped back up, so we learned to expect the rescue. That expectation is the danger. Because here's the terrifying question: what happens when the tools that saved us before don't work anymore? Interest rates have already been driven to the floor. Printing more money may now fuel inflation instead of stability. They might not be powerless, but they're not unlimited. And that's why complacency today is more dangerous than optimism was in 1929. The last rescue taught us to assume another rescue. That assumption can be fatal. So what does this mean for you? This isn't a call to fear. It's a call to preparedness. We don't know the exact date of a storm, but we can see the clouds. You've seen the vulnerabilities: 1, interconnected global debt; 2, an everything bubble; 3, digital speed panic; 4, and a public condition to expect saving. The next step is personal. Look at your own financial position with clear eyes. Are you overleveraged? Is your entire future tied to 1 or 2 high-risk assets? Could you survive if 3 markets fall at once? Now is the time to diversify, to build a cash buffer, to understand assets that historically hold value under stress. Think of it like building a lifeboat, not because you want the ship to sink, but because history says ships sometimes do. The psychology of 1929 was unprepared optimism. Our risk today is prepared complacency. You don't need to panic, you need to be prudent. Start asking hard questions, start making calm, informed decisions. Don't wait for the tremors to become an earthquake. If this gave you perspective, hit like and subscribe. In the next episodes, we'll go deeper into practical survival strategies for uncertain markets. History has warned us before. This time, we still have a choice. Stay safe out there.